Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Planet Labs.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we jump into the numbers today, we do have a really useful chart tool to share for investors and traders. If you want some help reading trading charts a bit more clearly, you can check out VIP Algos.
Yeah, the link for that is right below in the description.
Exactly. So VIP Algos is this TradingView indicator suite. It actually shows visual buy and sell chart alerts, trend direction tools, and even support and resistance zones.
Right, plus those take profit and stop loss planning areas, which are super helpful.
Oh, definitely. And it works across all sorts of markets, right? Like stocks, Forex, crypto, gold, indices, futures, you name it. But, and this is important, we do have to remind you that VIP Algos is an educational chart analysis tool only.
Right, it is definitely not financial advice.
No, not at all. It does not place trades for you, and it absolutely does not guarantee profits. Trading always involves risk, so, manage your risk carefully and always do your own research.
Always. And just a quick heads up, that link below is an affiliate link. So we may earn a commission if you use it, but at no extra cost to you.
Yeah.
All right, so with the charting tools out of the way, let's talk about a chart that is, frankly, giving investors absolute whiplash today.
Oh, total whiplash.
Yeah, there is nothing quite as fascinating as a massive contradiction in the financial markets. It's kind of like walking into a room where everyone is screaming that the sky is falling, right? But the weather report is telling you it's a perfectly sunny day.
Right, a total disconnect.
Exactly.
Yeah.
And that is the bizarre disconnect we are looking at with Planet Labs right now. On one hand, you have a business that just posted absolute record quarterly revenue. I mean, they are riding what could really only be described as a massive structural defense supercycle across the globe.
Yeah, the underlying mechanics seem to be firing on all cylinders.
Firing on all cylinders. But then you zoom out, you look at the actual stock chart, and it has recently suffered this brutal 25% drawdown.
Yeah.
It is a staggering divergence. So our mission today is to figure out what is really going on behind the scenes. We're going to unpack the raw data and answer one crucial question.
Which is?
Is this a fundamentally broken operation, or are we looking at a rare, asymmetric, wealth-building opportunity that is just, currently hidden in plain sight?
It really is the ultimate puzzle for an investor right now. I mean, you have this extreme polarization between what the business is actually doing in orbit and how the market is violently reacting to the financial mechanics of their stock.
Right.
It forces you to just step back, take a breath, and separate the long-term underlying business value from the immediate algorithmic noise.
All right, let's move into the wealth-building context. Whenever we talk about the aerospace sector, I think the average growth investor naturally gets a little nervous.
Sure, and honestly, rightly so.
Right. Because historically speaking, space is where capital goes to incinerate. Companies build giant rockets, they take years and billions of dollars to develop, things occasionally explode, and the profit margins are historically terrible.
The absolute worst.
So if we are trying to build a resilient, long-term portfolio, how does a space stock fit into that framework without just being a bottomless money pit?
Well, that is the perfect place to start because it highlights the fundamental misunderstanding that is driving a lot of the fear around Planet Labs right now. If you view them merely as a traditional space company, you're completely missing the actual wealth-building engine of the business.
Okay, so what are they then?
What they represent is a structural transition. They have already done the heavy capital-intensive lifting of putting high-cost infrastructure into orbit. What they are doing now is operating a high-margin recurring data subscription model.
Wait, I'm going to push back on that a bit because you say they've done the heavy lifting, but they still have to maintain a fleet of satellites, right? Space is still a notoriously harsh, unforgiving environment.
It is.
Hardware degrades. So how is this genuinely different from the historical cash incinerators we've seen in the aerospace sector for decades?
Okay, the fundamental difference lies in the unit economics between building custom hardware and selling the infinite data that hardware generates. Think of it like a traditional software as a service company.
Like a SaaS model.
Exactly, a SaaS model. But their data centers just happen to be floating in low Earth orbit. They aren't constantly trying to invent a brand new propulsion system or rocket. They are capturing visual data about the Earth every single day, archiving it and selling recurring subscriptions to that massive data feed.
Oh, I see.
Right, and for a portfolio looking to capitalize on global defense spending, that model is incredibly attractive because it scales beautifully. You pay to launch a satellite once, but you can sell the exact same data stream it generates to 100 different intelligence agencies and agricultural corporations simultaneously.
Ah, so buying the subscription stream, not the metal in the sky. Okay, well, now let's look at the fundamentals. Because if they are truly operating like a SaaS company with recurring revenue, we should be seeing that stability in their quarterly cash flow. Do the fiscal first quarter numbers actually reflect a software-style growth engine?
Oh, absolutely. The first quarter numbers for fiscal year 2027 are genuinely impressive. Revenue hit an all-time record of $94.2 million.
94 million. Wow.
Yeah, which represents a 42% increase year over year. And what's vital to note here is that this isn't some one-off government grant artificially spiking the numbers. This marks their fourth consecutive quarter of accelerating revenue growth.
I mean, 42% top-line growth is serious momentum for any sector.
Yeah.
Where's that sudden surge in demand coming from?
Well, the surge is heavily concentrated in the defense and intelligence sector. That specific segment skyrocketed 68% year over year.
68%.
Yeah, and geographically, the EME market, so that covers Europe, the Middle East, and Africa, that grew by a staggering 88%.
That's huge.
It is. But what really shows the versatility of the platform is that even their commercial sector, which usually lags behind urgent government defense spending, posted a very solid 28% year-over-year growth.
Okay, those top-line growth figures sound fantastic, but I have to bring up the glaring elephant in the earnings report.
Let me guess. The GAAP net loss.
Exactly. Looking at the bottom line, there is a GAAP net loss of $138.9 million. You cannot just brush past a nine-figure loss when your total revenue is only $94 million.
No, you really can't.
To anyone scanning a balance sheet, that just looks like a massive, blaring red flag.
It absolutely looks terrifying at first glance, and honestly, it is exactly why algorithms and retail investors panicked. But when you actually unpack the mechanics of that loss, it is essentially a profitability illusion.
An illusion? How so?
Well, out of that $138.9 million deficit, $107 million of it was entirely a non-cash warrant charge.
Hold on, walk me through that. A non-cash charge. Because to me, a $138 million loss just sounds like cash literally going up in flames. How does a company lose that much money without actually losing money?
Right. It's one of the more absurd quirks of GAAP accounting rules.
Yeah.
Okay, imagine you give someone a voucher today that lets them buy a slice of pizza from your shop next year for a fixed price of $2.
Okay, I'm following.
Now, if your pizza suddenly becomes world famous and is worth $10 a slice on the open market, that voucher is now incredibly valuable to the person holding it. But to your accounting department, that outstanding voucher represents an $8 liability. As your company gets more successful and the market value goes up, the paper value of that liability increases. And accounting rules force you to record that increase as a loss on your income statement. Planet Labs issued warrants, which are basically just stock options for early investors.
Oh, okay. So because Planet Labs' stock price appreciated, the value of those warrants, the vouchers, went up, and they were forced by accounting standards to record a massive loss on paper.
That is the irony of the entire situation. Not a single actual dollar left the building for that charge. It is a purely mechanical accounting adjustment triggered entirely by their own success in the open market.
That is wild.
When you strip away that paper illusion, their actual operations-adjusted net loss was only $8.8 million for the entire quarter.
Okay, an $8.8 million burn rate is a completely different universe than $138 million. And I mean, if they're only burning roughly $9 million a quarter, that makes their balance sheet look like an absolute fortress. They are currently sitting on $731 million in cash and short-term investments.
Yep, which is up 223% from the previous year.
Which is incredible. If you do the math on that, dividing a $731 million war chest by an $8.8 million quarterly cash burn gives them over 20 years of operational runway.
Over 2 decades.
They are virtually bulletproof when it comes to new-term liquidity risks. Even their expected capital expenditures for the upcoming year, which, they estimated $80 to $95 million to upgrade their fleet, those are easily swallowed by that cash hoard. They have comfortably survived the desperate, cash-burning infrastructure investment phase.
They really have.
So they have the cash,
Yeah.
and they clearly have the growth. But to justify a long-term hold, we need to understand the moat. What stops a competitor from just launching their own cameras? Maxar is a famous name in satellite imagery. What makes Planet Labs so irreplaceable?
The competitive moat is entirely about their temporal cadence. Planet Labs operates a massive constellation of over 200 shoebox-sized Dove and Super Dove satellites.
Over 200.
Yes, and this sheer volume gives them a daily global revisit capability. They literally image the entire landmass of the Earth every single day. No competitor, not even the heavyweights like Maxar, offers daily complete global imaging at a commercial scale.
Let me try to visualize that difference. Let's say you are a government intelligence agency trying to monitor a highly secure facility. Using Maxar is essentially like hiring the paparazzi for a one-off, incredibly high-resolution photo shoot.
Okay, yeah.
They get a stunningly detailed picture, but it's just a singular snapshot in time. Using Planet Labs is like having a permanent, unblinking security camera network covering the entire surface of the globe.
That analogy captures the value proposition perfectly. Maxar can tell you what is happening at a specific target at an exact, predetermined moment. Planet Labs can tell you what changed between yesterday and today everywhere on Earth without needing to be pointed at a specific target ahead of time.
Right, because they just capture everything.
Exactly. That creates a massive compounding archive of historical data. You can essentially rewind time to see exactly when a new clandestine runway was paved, or, track the day-by-day accumulation of troops at a border over a 6-month period. You cannot simply replicate that massive data moat overnight just by launching a handful of new shiny satellites.
And if you are an intelligence agency or a big agricultural firm, once you integrate that continuous daily data feed into your software systems, you don't just turn it off.
The metrics prove that out entirely. 99% of their annual contract value is recurring.
Wow.
Furthermore, their net dollar retention is sitting at 113%.
Meaning, not only are those enterprise customers staying on the platform, but they are actually expanding their usage and spending 13% more this year than they did last year.
Yep, it definitively proves the stickiness of the product and the pricing power of their platform.
That brings us to the Catalyst timeline. So if the customers are that sticky and the underlying business is growing, what is going to force the broader market to finally wake up? What are the near-term events that could act as a catalyst for the stock?
The most immediate hurdle is their second quarter earnings report for fiscal year 2027, which is slated for late August or early September. They are guiding for $102 to $107 million in revenue. But more importantly, they are guiding for an adjusted EBITDA of anywhere from break-even to a positive $5 million. Officially crossing over into operational profitability would send a massive, undeniable signal to institutional investors.
And from a technological standpoint, what is coming down the pipeline to drive that revenue growth?
We have the imminent launch of their Pelican 11 Gen 2 satellite, which is going into orbit via SpaceX's Transporter 17 mission.
Okay, what does the Pelican upgrade bring?
The Pelican fleet is a major upgrade because it brings up to 30-centimeter class imagery resolution. That is a massive leap in clarity, allowing them to compete fiercely on pinpoint image quality while still maintaining their unmatched daily revisit advantage. Alongside the hardware, they are vastly expanding the beta testing for their new AI natural language query application.
Wait, natural language query for satellite imagery, how does that actually work in practice for a customer?
Okay, so imagine you are managing global logistics. In the past, you would need a dedicated team of geospatial analysts to download raw satellite images and manually pore over them to count shipping containers.
Right, very tedious.
Super tedious. With this AI application, a user could simply type a question into a text box, much like a search engine, asking, "Show me all the ports in Southeast Asia where cargo ship congestion has increased by 20% in the last 30 days.
Are you serious?
I am. The AI instantly analyzes the massive visual data archive and delivers the exact locations and statistics. It completely democratizes access to the data, removing the need for a specialized analytics team, which massively expands their potential commercial customer base.
It is literally a search engine for the physical world. That is incredible.
It really is.
But taking a step back, we mentioned the structural defense supercycle earlier. Geopolitical tensions are clearly escalating globally. My skepticism, though, is about the speed of deployment.
Okay, what do you mean?
Well, government defense contracts are notoriously slow. Bureaucracy and procurement processes can take years. Can this super cycle actually move the financial needle for them in the immediate future?
It is a totally valid concern historically, but the reality on the ground is shifting rapidly because the nature of global threats is shifting rapidly. Look at Sweden's recent actions. They launched their very first sovereign reconnaissance satellite,
Okay.
and that launch happened just 4 months after the contract was signed with Planet Labs.
Wait, really 4 months?
4 months from ink on paper to operational hardware in orbit. That timeline proves that when governments feel a genuine pressing sense of urgency, the traditional bureaucratic friction completely evaporates.
Now let's pivot to the chart.
Yeah.
Because if sovereign governments can move that fast to secure their services, why is the stock chart moving backwards? Despite all this fundamental momentum, we still have that brutal 25% drop.
Right.
But when you zoom out and look at the long-term price structure, the setup actually remains surprisingly resilient. We are looking at a classic stacked moving average alignment.
Explain that for the listeners.
Yeah. The 20-day moving average, sitting around $43.87, is holding above the 50-day at $38.75. And both of those short-term indicators are well above the crucial 200-day moving average, which is way down at $22.66.
What that stacked alignment tells a technical trader is that the longer-term structural trend is still undeniably upward, even taking this recent violent volatility into account.
The stock is essentially trapped in a battleground zone right now. It dipped below that 20-day average, but it is fiercely fighting to maintain support of the 50-day. Key structural support is established right at $38, which aligns almost perfectly with that 50-day moving average.
Yep. And meanwhile, nearby overhead resistance is capping breakouts at $41.50.
Exactly. And when traders are navigating tight, volatile battleground zones like this $38 support level, they often rely on visual overlays to map out trend direction and manage their risk without getting overwhelmed by the noise of every single price tick. That's exactly where a tool suite like VIP Algos comes in, highlighting those crucial support and resistance zones dynamically on the chart.
Filtering out the emotional noise is the hardest part of trading a volatile setup. And speaking of noise, the volume profile on this recent sell-off was staggering. We saw over 40 million shares change hands.
40 million.
Yeah, that is massively above their average daily trading volume.
A massive spike in volume on a downward move usually implies panic.
Yes, but it also signals a climactic washout. Think about the mechanics of modern trading. You have algorithmic systems programmed to automatically dump shares if a stock drops below a certain technical threshold.
Right, the stop-loss cascades.
Exactly. Once it dips, those systems hit their stop losses simultaneously, triggering a cascade. Selling creates more selling until every weak hand is flushed out. Because of that chain reaction, the relative strength index, the RSI, which measures the velocity of price movement, cooled all the way down from being severely overbought to a neutral or even oversold reading.
Meaning the immediate knee-jerk selling pressure looks completely exhausted.
There is simply no one left who wants to sell at these depressed levels. And if you look at the options market flow, it is heavily skewed bullish. The put-to-call ratio for the near-term contracts is sitting at 0.42.
Meaning there are more than twice as many call options as put options. Institutional options traders are heavily betting on upside momentum.
Yep.
So what does market sentiment look like? Because if the options market is betting that heavily on a bounce, who is actually on the other side of that trade? It feels like the narrative out there is completely fractured.
Oh, the sentiment is heavily divided. There is a massive contrast between the retail news cycle and Wall Street analysts. The news headlines are heavily pessimistic, focusing almost entirely on the recent stock slide and retail fears of dilution.
Right, fear sells.
But Wall Street analysts, the people actually modeling out the forward cash flows, are decidedly bullish. We are seeing major price targets actually being revised upward. Needham just bumped their target to $53. Craig Hallam is projecting $49, and Wedbush is maintaining a strong $50 target.
Those targets represent a massive premium to where the stock is currently trading. Are the insiders within the company panicking alongside the retail news cycle?
Not in the slightest. In fact, we recently saw $108 million generated from public warrant exercises.
Interesting.
Yeah, that demonstrates profound internal and corporate confidence. The executives and early investors closest to the actual business operations are eager to hold the equity, not flee from it.
Okay, we have danced around it long enough. We have to talk about the speculative elephant in the room.
The rumor mill.
The rumor mill. This is the exact catalyst that caused the 25% drop in the first place.
Mm-hmm.
The company filed paperwork for a massive $1.5 billion at the market, or ATM, equity offering. As an investor, you have to ask yourself,
Why?
exactly, why does a company that already has an untouchable $731 million in cash and over 20 years of operational runway suddenly file the paperwork to potentially raise $1.5 billion?
That is the mystery that completely spooked the retail market. But if you analyze their balance sheet logically, market speculation strongly suggests they are building a massive war chest for a transformative M&A acquisition.
Oh, mergers and acquisitions.
Right. They might be looking to acquire downstream AI analytics firms to rapidly scale that natural language query application we discussed, or perhaps they are eyeing complementary space infrastructure companies to completely vertically integrate their entire data pipeline from orbit to end user.
Now let's talk about the risks. Building a strategic war chest sounds great in a boardroom, but I have to play the aggressive skeptic here. The mechanics of an ATM offering mean they can issue new shares directly into the open market at current prices.
Yes, they can.
A $1.5 billion offering is a massive, looming dilution overhang. The mathematical reality is that every time the stock tries to rally and build momentum, the company could step in and sell millions of shares, effectively capping the upside price movement and diluting existing shareholders.
That dilution overhang is absolutely the most immediate and tangible risk, and it is the exact mechanical reason why algorithmic traders dump the stock so aggressively. You cannot ignore the mathematical reality of potential dilution.
And the risks aren't just contained to the balance sheet dilution. I am looking at their operational margins. Their non-GAAP gross margins actually dropped year over year, falling from 59% down to 56.3%. And their forward guidance for the second quarter has them dropping even further, down to 52 to 55%. For a company transitioning into a high-margin data subscription business, you desperately want to see margins expanding, not compressing.
I completely validate both of those concerns, but we have to place them in the broader operational context. Let's tackle the margin compression first. That margin hit is largely a temporary accounting phenomenon associated with their growth phase.
Temporary how?
They are currently accelerating the depreciation timeline on their new Pelican satellites, and they are temporarily absorbing the higher costs of lower-margin AI partner solutions as they build out their proprietary platform. But remember, they are sitting on a staggering $906 million contracted backlog.
$906 million in legally contracted future revenue.
Precisely. As that massive backlog begins to convert into active, recognized revenue over the next few quarters, those fixed satellite depreciation costs are going to be completely dwarfed by the scaling top line. The inherent operating leverage of the SaaS model will kick in, and those gross margins will naturally expand again.
And what about the looming ATM dilution risk? How do they avoid crushing their own stock price?
That is where their existing balance sheet provides the ultimate counterweight. Because they already hold $731 million in cash, they are not raising capital out of desperation just to keep the lights on.
Right, they aren't backed into a corner.
Exactly. They are not forced to sell shares at these currently depressed prices. An ATM facility allows a company to be highly opportunistic. They can wait patiently for the stock to appreciate naturally and then issue shares into strengths at much higher valuations. This allows them to fund aggressive M&A growth while minimizing the actual dilutive impact per share on current investors.
So with everything on the table, what's the final verdict? Considering the massive ATM overhang against the backdrop of a $906 million backlog, where does that leave us?
Well, based on a comprehensive review of the fundamental momentum, the technical setup, and the underlying defense supercycle, the final bullish score comes in at an 8 out of 10.
An 8 out of 10 is a highly confident stance given the recent chart volatility.
The stance here is that the recent 25% sell-off is largely an emotional and algorithmic overreaction to the financing mechanics of the ATM filing. The panic entirely ignores the fundamental reality of their bulletproof cash position and their unmatched daily satellite revisit capability.
Yeah, the fundamentals haven't changed.
They haven't. What this price drop has essentially done is create an asymmetric entry point into a company that is rapidly becoming a high-growth, indispensable data monopoly.
What kind of time horizon are we looking at for this thesis to fully materialize?
The analysis suggests a 12 to 18-month view. You need to allow an adequate horizon for that $906 million backlog to start converting heavily into recognized revenue, and for the company to officially cross over into sustained adjusted EBITDA profitability.
Makes sense.
Once the broader market sees consistent quarterly profitability combined with that impenetrable recurring revenue moat, the narrative surrounding the stock will shift entirely.
We started this conversation by asking if we were looking at a fundamentally broken company, or if the market was just violently reacting to the wrong signals. It turns out the complex machinery in orbit is working perfectly. It's the market's short-term lens that might need a little readjustment. It is certainly something to think about the next time you look up at the night sky.
Absolutely.
And on that note, it always comes down to time horizons and managing your own risk. We must clearly remind you that this analysis is a discussion of probabilities based on the research. It is not financial advice, and you must always manage your own risk and make your own investment decisions.
Yep, do your own due diligence.
And if you want a cleaner way to read trading charts while you do that research, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas. It can help make complex charts easier to scan, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee any results. Trading involves risk, so always do your own research and manage your risk carefully. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this talk helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.